Good evening, everybody. Thanks very much for joining us again. This week, I want to take a look at what I think are the five most interesting charts within markets at this time. Now, obviously, coming into the Fed, which are due sort of any minute, these outlooks could change. But I think certainly coming into the announcement, they've been very interesting in terms of the price moves that we've seen, and the risks are that if we certainly start to see levels give way that we'll talk about, then that may well trigger more significant moves in the direction of the break. So let's take a look at the charts and just sort of see where the risks are perhaps beginning to materialize. Well, I'm going to start with the US Tech 100 index. And to be honest, this is a pretty much a proxy for all US indices at present, because the theme of late has been the ability to completely ignore overbought and overextended conditions. And obviously, when somebody starts talking about price action being overbought, it automatically puts you on a cautious footing, with the risk of a correction, a sell-off beginning to develop as a reaction to that latest advance. However, what we're seeing within the US tech sector and the other US indices as well is an ongoing theme of positive sentiment and bullish trending conditions. And quite simply, when a market is seeing that type of environment, it's a matter of they are more likely to ignore overbought and overextended conditions because sentiment is still more bullish and trending still highlights positive conditions that are dominating the market. So currently, what we have within the US Tech Index is a confirmed uptrend. We're still posting higher highs and higher lows. We've recently broken above the recent failure high, and this is the weekly chart. So you can see a lot of the recent price action. But you can see that the latest rally has been a consistent push to higher levels. The mid-average of Bollinger Bands has turned higher again, and this basically is just a very basic indication of the trending condition currently within the market. So if the moving average is rising, we're trading within a bullish trend. But more significantly, coming from the Bollinger Bands, is that the bands themselves are beginning to widen, and this reflects increasing positive volatility behind this move. And we're also tagging the upper band. And this is a consistent signal across the various US indices that you could look at. Now, so what does this mean? Well, this highlights an ongoing, more positive sentiment that's dominating the market and the risk that we can extend towards higher levels. Now, the thing that we need to bear in mind is that we are approaching a significant high posted in November 21 at 16,766, which is the all-time upside extreme. So that is going to be a focus. But if we can see breaks above that, then the risk is that this will trigger further extension towards higher levels as these positive trending conditions and bullish sentiment continues to dominate. Okay, so where would the market perhaps begin to see a cautionary tone? Well, at this stage, it's really on a longer term basis while we're above the rising Bollinger mid-average, which is somewhere below price action at 15,355. But it does highlight an important longer term support area. And even though the market, if it does correct, if we come back to this region and find fresh support and push higher once more, that it may well be a trigger for fresh strength. So the theme would seem to be within the US equity markets at present for ongoing upside, positive volatility beginning to materialize and suggesting that we can push higher, although we do need to challenge and break above these all-time highs to maintain this push higher. But certainly, while we're above the mid-average, for instance, in the US Tech Index, the risk is that downside appears limited and we can see further attempts to push higher. Okay, so that's pretty much using that as the proxy for the US and for the Germany 40 index as well. When we look at the UK 100 index, it's a slightly different picture. It's not as aggressive in terms of the recent strength that we've seen. We've rallied, but the market has underperformed significantly against its US and even European counterparts. And for the UK market, it's interesting because we're caught within this converging consolidation area. And quite often, this type of activity can continue for a prolonged period of time. Now, having seen the original move push to the upside, this can often turn into a continuation pattern, which would suggest that we could break higher. And certainly when we look at the daily Bollinger Mid average, while it's not an aggressive increasing positive volatility, we are trading within a bullish trend. We're tagging the upper band and finding support each time a setback is seen towards the rising mid average. However, the focus really into year end is going to be either the resistance at 7,714 or the support at 7240. And really for the UK market to trigger a more significant move within the direction of the break, we would need to see a closing break of either of these levels to suggest the more significant directional move. So while we have the US and some of the European equity markets continuing to see more positive themes, and the risk is that that can well extend, certainly for the UK market, we are still more on a watching brief, waiting for the breakout from this consolidation area to really trigger a more significant and upside move. So we may see upside develop because we're trading above the Bollinger Mid average. And while that remains the case, we could retest these upper levels, but closing breaks are needed to see a successful move and further strength within price activity. Okay, so let's move away from the equity markets and take a look at FX. And the US dollar at this stage is very interesting. So I thought I'd just look at the US dollar index to give us an overall perspective for the dollar and likely price action. Now, obviously, again, the Fed is likely to have a significant driver in terms of sentiment, but it's interesting the price action that we've recently seen. For instance, the market has broken back above its mid-average, a Bollinger mid-average, and having hit what were historically oversold readings in late November, the market has successfully rallied back, broken above the average, which is now beginning to turn up, which is more constructive. I wouldn't say it's necessarily positive, but it's constructive. It's confirming this level as a support point to the downside. And while we're closing above that level, the risk is that we can attempt to develop a more sustained upside move. However, what we need to monitor is the Fibonacci retracements of the latest sell-off, because as you'll see, the latest upside has been held by the 38% retracement level, and we've failed to close above that on a consistent basis. So as important and potentially strong as the support level offered by the mid-average actually is, around just above the 103.50 area, equally important is this 38% retracement at 104.15 and just under. We would certainly need to see a break of either of these levels to suggest the direction of the next significant leg. And while we may well suggest, and even because the mid-average is rising, suggest further pressure on this upside resistance, we do need to see successful closing breaks to trigger a more extended upside move towards the midpoint or even 62% retracement levels. So either of these points are my focus at the moment, and certainly coming into the Fed, I would monitor how the dollar trades in terms of the announcement. And if we do start to see these breaks giving way, it may well suggest the next bias and directional risks for the market as they develop. Now, let's take a look at commodities, having looked at equities and the FX markets. And gold, well, if I'm looking at interesting charts at the moment, then gold has to be in there, because we saw, obviously, a couple of weeks ago, this very, very sharp acceleration higher that took us to all-time highs. We tested Fibonacci extension resistance points, and the market has rejected very aggressively from that level. Now, this was a very low volume move. It has the feel of a buying climax where everybody has rushed to get long, or the market has suddenly accelerated sharply higher, that People have viewed that as an opportunity to close out positions and look for a more extended rejection, which seems to be materializing. However, while we've broken below the mid-average and the 38% Fibonacci retracement point, we're now finding support at 1979, which is the midpoint of that October-December move higher. So this would seem to be quite an important support area and a level that we need to monitor the defense of on a closing basis. And while that's intact, we can see further attempts to push higher once more. But obviously, if it does start to give way, the risk could be for a deeper sell-off. Okay, so we know the support point to the downside. In terms of the resistance points that we need to break to suggest a more sustained upside move, then for me, again, it's the Bollinger Mid-Average at 2008 that highlights the important resistance focus. If we can hold on this midpoint, rally and break above that level, then we may well see a more sustained upside move. But again, it would be Fibonacci retracements of the sell-off that then come into play to highlight the next resistance points to the upside if a more sustained recovery begins to develop. So 2018, the 38% level, 2061, the midpoint, and 2080, the 62% level. So again, the chart of gold is very interesting because we've got clear and distinct levels that we need to monitor. We haven't necessarily got a clear signal yet in terms of the next directional risk, but if either of these points start to give way, then for me, gold will become much more interesting and the potential of a more sustainable move within the direction of the break would be in place. And finally, I just want to round up by looking at crude, because obviously it's been already a very significant sell-off from the recent highs. And I think, obviously the market again is overextended to the downside, maybe even oversold. But this is an evidence of the market ignoring these oversold conditions. But we are heading back towards what should be a potentially strong support offered by the June lows at 66.78 down to 67, up to 67.04. So this range should be a potentially strong support focus, having seen the market already sell off a significant amount. But it is a downtrend. The market is continuing to struggle in the rally, and we break back below if we the declining Bollinger Mid-Average, which suggests further acceleration to the downside. But that mid-average, and even before that, we've got the latest failure high at 71.93, which was posted yesterday. Then we need to see how the market defends that if we do start to rally back. But 71.93, 73.81, which is the declining Bollinger Mid-Average, all mark important resistance focus. So again, while the lows from dating back to June are potentially going to be strong, we have to see a successful break above this resistance range to trigger a more sustained upside move to retest the failure highs within this downside move. So I think it's going to be quite an interesting reaction to the Fed. And beyond that, because I think certainly we have clear and distinct levels that are very important technically across a number of asset classes, and how these are defended are going to be very important over the next few days, and certainly try and establish where the next directional risks are going to be into year end and beyond. So that's for me for this week. Thank you very much for listening again. I'll wish you a very happy Christmas and a very prosperous New Year. And we'll be back in the new year. Thanks very much for listening.